So now for the refresher. Last year I spoke about the importance of having a methodology or a framework for knowing when to buy and sell stocks. We talked about and walked through our HMA, the process that we use, how we look at a worst case analysis, formulate a worst case price, a buy point, a sell point. And we use this, the way I did it is illustrated this process by using a series of slides, which was designed to show how our process is designed to capture those value gaps. It allows us to capitalize when the price of a stock becomes disconnected with the underlying value of the business. In those slides, I used Apogee Enterprises as the example company, which we'll do again today. In our process, we have 14 valuation metrics that we use, but today I'm going to isolate just on one, and that is tangible book value and the price to tangible book value. There may be some that aren't familiar with the term, so let's review that quickly. If we start with the total assets of a company and then subtract the total liabilities, we end up with book value, also referred to as shareholder equity. From that, if we subtract off all the intangibles, which is goodwill, trademarks, and patents, we'll arrive at tangible book value. If you take tangible book value, divide it by all the shares outstanding, you end up with tangible book value per share. So we look at tangible book as a very good proxy for the underlying value of the business over time. It doesn't equate to the intrinsic value of the business, but it's a great measure or a gauge to the growth of the business and the direction of the underlying value. So here we look at a graph of tangible book from Apogee Enterprises from 1990 to present. And we can see that while Apogee is somewhat cyclical over time, it's grown quite nicely over the last several decades, and with each peak being higher than the previous peak. On this next slide, we see the price of Apogee Enterprises for the same time period. And we can see that the price is far more volatile than the underlying business. It's gone from 5 to 30, back down to 5, up to 30, down to 10, back up to 30. And you can see it's far more volatile than their underlying business when we compare it to the book value in this next chart. So here, not only do we see that the price moves up and down more significantly than the underlying value of the business does, but it does so more frequently as well. It's these wide and frequent price moves, also known as volatility, that gets investors so nervous. However, when we look at it very closely, we can see that it doesn't matter how scary the economy is, or how ugly the headlines are, or how nervous investors are. Every time Apogee hits 1 times book, 1 times tangible book, during times of maximum pessimism, it's the bottom. Here we combine both the price and tangible book into a ratio. By doing so, we're comparing the price of the company to the underlying value over time. So at the bottom we see, again, Apogee is selling at 1 times tangible book, which is labeled the value zone. At the peak it sells at 3 to 4 times book, which we've labeled the expensive zone. So by evaluating price in combination with value, we can see volatility isn't something to be feared, but can be something we can cheer. So why would we cheer it? Well, because when people are more concerned about price than they are value, when a price declines, they end up selling a stock irregardless of when it becomes a great value. Well, basically, they're handing us a gift. On the flip side, though, when everything's rosy and everything's looking up, these same investors pile into the stock, driving the stock up to the higher levels, at which point we're very happy to sell it to them. So you can see, at this point, not only did they hand us a gift at the bottom, they were gracious enough to double that favor and buy it from us at the top at a premium price. Now, if that's not something to cheer about, I don't know what is.